In this video, we're going to be taking a look at how to create and use monthly standard deviations. So let's take a look. All right, so you'll notice on the screen we've got our chart of SPY back up in front of us. We've got our point of control listed here that we created in the last video, and you'll notice that I've switched over to a monthly time frame for this chart. So this chart goes all the way back to 2010. I'm going to do that because I want the data, I want to see the monthly standard deviation for November, and I want to use that data to trade in December. So the first thing you want to do is you'll notice on the bottom panel I've got the standard deviation study inserted. To do that, you can go up to your studies, and you'll see that I've got standard deviation listed here in the lower panel. So we're going to use that. In that panel, you'll notice that it's got the actual chart of the standard deviation showing, but for us, the more important data is going to be right here where it shows the actual number of the standard deviation for each month. So to start with, we're going to go back to November's candle. I always want to do this at the end of the month to trade with that data in the next month. So for this example, we're going to look back at November's candle, which closed at 314.31. So you want to write that down. And then if you look down, staying on the same candle, if you look down to the standard deviation, you'll see that the standard deviation for that month was 15.99. So we're going to write that down and then either add or subtract from the closing price to give us some standard deviations to use for December. So if I pull up a calculator, we're going to start off with 314.31. We're going to add 15.99. That's going to give us 330.30. That's going to be the first standard deviation for the month. And then we're going to add 15.99 to that number, and that's going to give us 346.29, which we're going to use as the second standard deviation to trade with in December. We're going to go back and do the reverse of that to get the negative standard deviation. So we're going to take 314.31 and subtract 15.99. That's going to give us 298.32. We're going to subtract 15.99 again. That's going to give us 282.33. All right, so let's switch back over to a daily view and put these price levels in. So I'm going to go back over to my drawings. We're going to start with a price level, and I will do these at the beginning of the month. So I'm going to start, we'll just edit it as we go. So I'm going to do the second standard deviation first. So I'm going to type in the name SD2 so I can have a reference for it. We're going to put in our value of 346.29. And we can change the start date, so it'll show nicely on the chart to December the 2nd. We're going to go in and edit our color, whichever color you like, and we'll leave it like that. All right, so if we go back up to the chart now, you can see SD2 is showing at 346.29. So we're going to go in and duplicate that. And go in and edit it to put in SD1. Put in our value of 330.30. And now we've got SD1 on the chart. And we're going to keep doing this for negative SD1 and negative SD2 as well. So we're going to duplicate the drawing again. Go in and edit it. This time we're going to put negative SD1. That level was 298.32. And then for the last one, we're going to go down here. Put in negative SD2. And the level was 282.33. There we go. All right, so let me switch back out and we'll take a look at how we can use this data to actually trade in. As you'll see in the article, what are standard deviations and how do we use them? If you look at the graphic in front of us now that I've pulled up, you'll see here, basically this would be considered this line negative SD1, and this would be the negative second standard deviation, this would be the first standard deviation, this would be the second standard deviation. So what you see here are these percentages in the middle tells you what percentage of chance you have of remaining or ending closing from a trading standpoint. How much of a chance do we have to close within those boundaries? So within the first deviation, 68% of the time trades for the month should close within the first standard deviation. That would include a range of the first standard deviation down to the negative first standard deviation. If you look at the second standard deviation, trades should close the month 95% of the time within those boundaries. So if I look at the chart of SPY, when the month started here at December the 2nd, if price moves up to the second standard deviation, it should close below that line 95% of the time by the time the month ends. And likewise, if we had a sell-off in December, price should close out the month of December 95% of the time above the negative second standard deviation. So how can we use that information in trading? How can we use it to identify emotions in charts? I'll take a look at it from both extremes. So you can see how December's played out. We had a small sell-up at the beginning of the month and then we rose. We're still noticing below the first standard deviation. So the market may feel like it's gone up a considerable amount this month. In reality, from a dynamic standpoint, it hasn't gone up that much. So if price did go up to the second standard deviation, would you be buying or selling at this level? Folks that are buying, if price had risen up to the second standard deviation level for the month, folks that are buying at that level, they have a 95% chance that by the end of the month they're going to lose on that trade. The only reason people be buying at that level is from a fear of missing out. When you see FOMO, that's what we're talking about, a fear of missing out. We want to use these charts as opportunities either to take profits if we're on the long side and price has risen and you see resistance maybe at the first standard deviation, or if we get up to the second standard deviation in the month, these are opportunities to take profit and or short. The flip side of that, if we were trading down at the bottom of the negative second standard deviation for the month, who would be buying and who would be selling at that level? Why would you be selling if you knew you had a 95% chance that the market was going to go up from that level by the end of the month? People sell at those levels because they're scared, because there's fear, because there's panic. These are opportunities in the market when you see them to buy and go on the long side to make money going into the end of the month. And that's how we can execute and use monthly standard deviations on charts.